Now, let me be completely honest with you. If you're trading every red folder news, orange folder news on ForexFactory, whatever, you're just overloading yourself with what I would call nonsense. And I know that because I've actually used to do the same thing. I open up an economic calendar like ForexFactory and whatever and see high impact news events, red folder, orange folder, whatever, and feel like I needed to have an opinion on all of them. And if I didn't trade them, I would feel, the fear of missing out. But here's what I actually learned in more than a decade of trading fundamentals. Well, most of the news, 80% of the news, I would say, and you'll see why in a second, do not matter. At least not in the way you think they do. So in this video, I'm going to give you just one filter that will instantly cut through the noise of 80% of the news so that you'll know what to focus on to catch the big moves. See, this is the biggest trap that most traders fall into. They think that they get more edge if they follow more data. So what do? They consume everything that's listed on ForexFactory calendar, every PMI, every inflation number, every GDP number, every random confidence index. They follow everything. And that way you feel like you're getting a view on the market, you feel like you're getting a fundamental view on the market because you're looking at, this number printed worse than expected, so it's bearish for the euro. That's completely nonsense. I'm going to show you why in a second. What's actually happening here is that you're spending most of your mental energy on releases that do not change anything meaningful. So you're focusing on getting chopped out in moves that are actually not really tradable. And then what happens? When the one release that actually shifts the narrative and starts to pull a move towards a different trend that can be traded, what do? You miss it because you've been chopped out into the noise and you don't trust the move anymore. And that's the cycle. You try to trade everything, try to catch every move, you get chopped out, you skip the next trade, and that's the one that actually trends 200 pips, whatever. I can feel you nodding behind the screen because this is 90% of traders. So here's how you can fix this. The sweet spot is knowing and understanding which data actually matters so that you know what creates a trend and what doesn't. So I've shown you a chart earlier with the illusion of having more data equals having more hedge. Well, that's not true. The optimal hedge is in the right amount of data, which is what I'm about to show you right now. So first of all, understand that volatility is not signal. Now, a big candle like this is not a signal of something important happening every time. A big candle is not proof that something important happened. Just because price jumps, 20 pips on the 1 minute time frame, it doesn't mean that actually the macro picture changed. If a data release, whatever it is, hits the market and the market moves, it does not necessarily mean it's a move about to start a new trend, okay? What I'm trying to say is that a big candle does not necessarily automatically mean that something important happened. Instead, to understand what actually starts trends and what does not start trend, there's one filter. The one question that macro traders ask before touching and trading the news is, does this change what the central bank will do next? Now, this is the gatekeeping mechanism where every news event, every news release must go through in order to understand whether this is something that you can actually trade or not. So the one question to ask is, does this news release change the picture for what the central bank will do next? Now, if the answer is no, you do nothing. So if you want to trade macro and if you want to trade the news, you have to stop thinking like a retail trader. Sounds easy, I know, but follow me through here. You have to think, or at least try to think, how a central bank would think, because the market does not move on headline just for the sake of moving on headlines, okay? The market moves on the expectations of what the central bank will do next, which is created by what? By the news events. The news feed into expectations of what the central bank will do, whether they're going to hike, whether they're going to cut rates, and that moves the market, okay? And here's the point. Central banks do not care about everything. This is the most important part I want you to take from this video. They care about what? inflation and labor market. That's their mandate. That's what they by law have to do. They have to support the labor market and to keep price stable. So the task for them is pretty much asking themselves, are we comfortable with inflation? Are we comfortable with where the labor market is? If not, what we do with rates. Okay, so when the data hits or the news release hits the market, the real question is not, was the news above or below expectations? That's the retail mindset. That's where you get stuck and where you get chopped out into fake moves that do not lead to a trend. The question to ask is, does this change what the central bank will do next? Okay, that said, let me show you the trap. You're watching a pair. Let's say it's Euro USD on the 1 minute time frame. A mid-year data releases misses expectations. We have the flash manufacturing PMIs, which was expected around 52.4, actually released 52, and the other one as well, 53, actually released 52.3. Okay, it's a miss, but here's the point. Price jumps 20 pips. We're looking at Euro USD, so the dollar weakens on the release. Okay, your logic says something happened here. You clearly see this. It could be a pivotal moment, which gives you what? Fear of missing out, because the market is moving. You think that the news actually meant something just because the market is jumped. So what do? You chase the move. You start the position, but you guessed it, 2 minutes later, you get stopped out. And what do? You blame the market makers. The market is manipulated and whatever. Now, what actually happened here? Well, the data created volatility, but volatility is not signal. Volatility is not indication that something important happened. The piece of data itself, in this case the flash manufacturing PMI and flash services PMI, did not change anything for the Federal Reserve. Yes, they came below expectations, but does this really change something for the Fed? Is the Federal Reserve really gonna cut rates or cut more than expected just because the flash manufacturing PMIs printed a little bit below expectations? Well, no. So what happens? Well, big funds don't have a reason to reposition, don't have a reason to enter the trade, so there's no sustained move, okay? Now let's contrast that with, imagine the market is priced in, there's a belief that says no cuts. The Federal Reserve is not gonna cut. Now, suddenly a piece of news hits, it's inflation, which is what? Core data point that is entrenched into what the central bank is going to do, because they have to follow a certain mandate, and that mandate includes price stability, which includes inflation. So the belief is no cuts from the Federal Reserve. Suddenly, the CPI, headline CPI, comes well below expectations. See what's going on here? The narrative shifts from the previous narrative, there was no cuts expected from the Federal Reserve, to when do rate cuts start? Because inflation, a core pillar data point of the Federal Reserve, of pretty much any central bank, just missed expectations by quite a bit. So the narrative has shifted. Suddenly the conversation has shifted. Why? Because an important data point, a data point that matters for the central bank, just printed, and it printed deviating from expectations. Now, this is when the market move is not just volatility, but it's actually the start of a trend, because a new narrative is taking shape. That's a narrative shift. This is what forces a repricing. This is what creates a trend. This creates a trend. Let me say that again. This creates a trend based on a single news event. Why? Not because just the news event printed above or below expectations, but because that was a data point. That was an important piece of information that changed expectations for what the central bank is going to do next. Do you understand the difference here? One creates noise and the other one creates a trend. Why? Because one doesn't matter for the central bank. It doesn't change anything from the central bank. It doesn't change expectations for what the central bank will do next. And the other one instead does, because you went from no cuts to when do cuts start. That's the beginning of a new trend that you can trade, that you can position for. This is where you can actually chase the move. So if you take one thing from this video, I want you to make it this. Stop trading news in isolation. So the better than expected, bullish, and worse than expected, bearish for the currency. That's retail mindset. Instead, start trading the spillover effects that the piece of data creates for the central bank, because this suddenly will reduce the number of trades and the number of news that you watch down to 20% or so. Because if it doesn't matter for the central bank, it doesn't matter to markets, okay? An isolated news, if it doesn't matter for the central bank, it's going to just chop markets, okay? It's just going to create volatility that cannot actually be traded. So how do you solve this? Well, by understanding that the central bank cares about two things. It doesn't care about every single piece of news, every single piece of indicator, economic indicator. It cares about what matters for its mandate, inflation and labor market. And the moment you realize this, well, obviously your watch list shrinks a lot. You watch way less data and you start tracking way less trades, but at the same time, you get much cleaner trades, okay? Your trades become cleaner and you start getting whipped around by candles, which you should have ignored in the first place. So let's build a checklist that you can actually use from today. Number one, before any news trades, gotta ask yourself, does this change the picture for the central bank? Number two, if it's a no, well, what do? You do nothing. Like the example with the flash manufacturing PMI we saw earlier. If it does not move the needle for the central bank, you simply do nothing. You sit on your hands and do nothing. Now, on the contrary, if a piece of news that matters for the central bank hits the market, whether that's inflation, labor market data, and it actually moves the needle because it's much better than expected or much worse than expected, then you gotta understand, obviously, does this move the needle for the central bank? Is this going to change the narrative from, maybe 125 basis point cut into probably the Fed is going to cut 50 basis points, or it shifts, in the example we saw earlier, it shifts the narrative from no cuts to when the cuts start. The point is understanding the shift in expectations, okay? And the data that actually creates that opportunity is the data that matters for the central bank. And on top of all of this, remember, direction is macro, okay? We get the overall direction in which something is going to move from the fundamental context, but the timing and the entry should be from a technical perspective, because you gotta get the right risk reward, you gotta get the right timing, and so on and so forth. Now, with all this said, if this video helped you clear a little bit your charts and how to understand news, well, hit the like button and subscribe. It helps the video reach more traders and it tells me to make more videos exactly like this one.